Earlier this year, I bought put options on Tesla stock and sold them for a gain over 100%. So I was happy about my return on investment. It didn't even take a couple of months to get that big return on investment buying put options on Tesla stock. Now, as Tesla stock has increased to astronomical levels again, trading above $400 per share, I saw it as an opportunity to do this again. I bought put options on Tesla stock expiring December 2026, and I'm going to discuss why I made that move and my biggest concern on this investment, on this put option, where I see the risks of downside here to this investment and why I made this decision.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Look at a price chart here for Tesla stock. When I first bought put options around January, the share price was above 425 a share, and the price crashed relatively quickly in a couple of months down to the low 200 levels. And then I cashed out. I earned a return on investment over 100% on those put options. Now, the rest of the year has seen Tesla's share price explode to the upside. It's now trading at over $437 per share. And it's been a mixed year for Tesla. There's been some positive developments and there's been some negative developments. But looking back longer term, what I'm noticing from Tesla is a competitive weakening in its core car sales business, which is driving revenue lower for this company. And remember, when you're a vertically integrated business, the way Tesla is, it does its own manufacturing, it's trying to build its own batteries for the electric vehicles, even though it's not sourcing all of its batteries internally, it's building out the infrastructure for the charging stations. All of the business suffers when you're seeing revenues declining because your costs stay the same. That's the downside of a vertically integrated business, is when sales are falling, your profits are falling much more quickly. Tesla's business has been in decline here from $97 billion in sales in 2023 down to 92.7 in the most recent trailing 12-month period. And recent developments have been negative for Tesla. For instance, the tax credits expired in the United States on September 30th. People will no longer be getting those tax credits for purchasing electric vehicles. Already, people were purchasing less than 1 out of 10 car purchases were electric car purchases. And without the tax credit, that's going to put EVs at an even more competitive disadvantage. They're already more inconvenient for the vast majority of people, unless you own your own home and you have the charging at your home with the solar and you get to charge all of that. That makes it convenient. It makes sense for those individuals, but that's a small population compared to the overall population. So that's been one negative with Tesla in recent weeks. The lower priced models were much worse than I was expecting. The $37,000 price point was much higher than I was expecting. And remember, Tesla had been promising investors a $25,000 model. Instead, they gave you a $37,000 model. Now, I wasn't expecting a $25,000 model. Anytime Tesla provides a forecast, I adjust it upwards or downwards based on if it's too optimistic for revenue figures. I adjust it downward. If it's too optimistic on cost, I adjust the cost upward. Whether you're looking at cost or revenue, Tesla almost always provides an forecast that's too optimistic. So as an analyst, it requires me to adjust their figures to more realistic levels and not optimistic levels like the management team is continuously providing investors. So I see revenue declining further here. The next few quarters are likely to be painful. Even the management team indicated the next few quarters are likely to be painful. The next topic, the rollout of driverless cars, the testing in Texas, that's gone about as well as I expected it to go. It hasn't disappointed the way that the lower priced model disappointed. I- it's gone, relatively uneventful, which is what you want to see from this kind of a rollout. There's only a downside. They can't hit the home run, but they can strike out. And so what they needed to do here is just make progress with the driverless testing, and they've done that. And that's one of my main concerns here with this purchase of the put option is the advancement of the driverless technology. Not like rapid advancement, I don't expect that, but even if they're able to make like a small step forward, I'm concerned that the market is going to give them credit for a much bigger progress. Tesla is the best marketing team in the world. I don't see any other company with as good as an ability to market their progress. They take one step forward and they're able to sell it to investors as a 20-step stride forward. And that concerns me buying the put option because they have that capability. Even if something is less than stellar, they have that ability to convince investors that it was this big jump forward. So I'm concerned about that. My money's at risk, and I'm concerned, and I give credit to the management team's ability to have that kind of influence on their investor community. Another thing I'm concerned about is that Tesla is an excellent car company, right? In my opinion, it's not a very good AI company, not yet, but it's a great car company, one of the best in the world. And this metric shows just how good they are. Their operating cash flow to sales ratio from 2015 to 2025 is trending upward very nicely. And it's among the leaders in this metric among all car companies. Now, this metric is likely to get worse given the removal of the tax credits and incentives to purchase electric vehicles. This metric is likely to get much worse. And then combine that with the large investments in research and development the company needs to make to develop its driverless business because it's nowhere near ready to be rolled out where it's generating revenue. And so the cash flow from operations, I expect this to not be moving upwards any longer. In fact, it could be moving downwards. I want to see more details about the lower priced models, how they're going to cannibalize existing sales from the slightly higher priced model versions of the existing cars they have, and the margins on these lower priced models. What are these margins going to look like? We don't know yet. So I want to see those numbers come out. And it's a risk for me that their cash flow from operations continues moving higher because they're able to remove more cost from these lower priced models and lower the price by less than that. So if you remove $10,000 in the cost of production and you lower the price by $7,000, you've just now created a $3,000 increase in contribution margin of every vehicle sold. I don't think that's the case, but that could be the case, and I'm concerned about that. And it's one of the reasons why, even though I made this purchase of the put option, it's a relatively small part of my overall portfolio. It's not going to hurt me very meaningfully if Tesla's share price goes to $700 per share. I purchased the put option, so my downside is limited. So the main reason why I purchased the put option is because of valuation. Tesla stock is trading at a forward price to earnings of 214, and it's just way too expensive in my opinion. I think investors are overly optimistic about its prospects in driverless car technology and robotics, and they're underestimating the negative impacts to its overall business from the decline in the EV industry. Its cash flow generation, if it starts to decline, that's less money the company will have to invest in these more innovative technologies. So Tesla is trading at a forward PE of 214. And if you look at GM and Ford, they're trading at forward price to earnings of 6 or 8, right? So Tesla is 30, 40 times more expensive than these car companies. Okay, then if you say, well, Tesla's an AI company, okay, so let's compare it with Nvidia and Microsoft and Google. Well, those companies are trading at forward price to earnings of around 25 to 32. So Tesla is what, 7 times more expensive than the AI companies? So whether you're comparing Tesla with AI companies or car companies, Tesla is trading at multiples of their valuations, suggesting that all of that premium is related to driverless car and robot technology, and I think that's overly optimistic. Furthermore, I calculated a fair value on Tesla stock using my proprietary DCF valuation model, and my intrinsic value per share came to $111. The market price is $427. Nice to see that it's down 1.74% today. But if you look at my discounted cash flow valuation, you can see some pretty optimistic forecasts or some pretty bullish forecasts for Tesla's growth in free cash flow. Between 2025 and 2035, I have forecasted in this model that its cash flow grows from 3.8 billion in 2025 to 87.5 billion in 2035. So over the next 10 years, I'm basically forecasting Tesla's free cash flow to absolutely soar by more than 20x increase in free cash flow I forecasted in my valuation model for Tesla over the next decade, beyond 2035, okay? The longer term rate in free cash flow growth I forecasted for Tesla is 7%. That's higher than any other company that I'm following and the long-term growth rate I'm using for the company. I'm giving the company credit for making investments in driverless technology and robotics, which are not likely to start generating free cash flow for several more years. And then the growth rate from those segments are likely to persist for much longer and drive above average growth. And so I'm giving them the benefit of the doubt, that I'm giving them credit for that, right? I'm not saying, I've never said that it's a 0% probability that they will create these products. I've just been saying that the market is overestimating the probability of success and overestimating the cash flow from operations, the free cash flow, if they do indeed deliver this product. That's my difference between what the market views and my view on Tesla. So even with those optimistic forecasts, I calculated an intrinsic value per share of 111. And the cost of capital, I'm just using your standard capital asset pricing model. I haven't made any adjustments. The beta, I'm using the beta of the company 2.08, cost of debt at 7%, debt to equity ratio based on its total debt divided by its market capitalization, risk-free rate of 4.1%, market risk premium of 6%, which gives them the cost of equity of 16.6 and a weighted average cost of capital of 16.53. I haven't adjusted its beta higher based on an added level of risk. So for these reasons, I bought the put option on Tesla stock, and I highlighted the concerns. This is a risky investment. The put options are already risky, but when you're buying an option on a stock that's risky, you're magnifying and multiplying the risk. So I made sure to size this purchase to a relatively small percentage of my overall portfolio with huge upside potential.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.